Hello, everybody. I'm your host, John, and today we will be doing a fundamental analysis of Qualcomm. Now, as you can see, through the past 5 years, the company is up by only about 28%, meaning that they have underperformed the overall market. Now, through the past 6 months, they are actually up by 21.5%, meaning that the tides for this company might actually have turned. Now, the reason for that is that Qualcomm is a company that specializes in creating wireless technology. Now, to understand the value of Qualcomm's product, we can have a look at the semiconductor value chain. As you can see, we have the companies that create the machines that create semiconductors. Then we have the companies that use those machines to create semiconductors. And finally, we have companies that use the semiconductors to create technological products. As you can see, we have Qualcomm right here. You can compare Qualcomm to Nvidia, for example, except Qualcomm specifically uses chips to create wireless technology, unlike Nvidia or Apple or Google, for example. And as we are currently seeing a rise of autonomous driving vehicles and AI, there will be a lot of need for Qualcomm's product, for wireless technologies, and that's why I believe that Qualcomm into the future has a very bright path. Nevertheless, to figure out if the company is actually a buy at their current trading price of $165, we have to do a fundamental analysis. And we will do that by first analyzing the 9 pillars and secondly calculating the intrinsic value using the tools in MoneySense, which is a powerful site specifically designed for long-term value investors and allows you to effortlessly but very effectively analyze any company to see if you should buy, hold, or sell. But now jumping back to the 9 pillar analysis, first we will have a look at the financial growth, starting with the revenue growth. So as you can see, the 10-year average revenue is sitting at $29.5 billion, while the 5-year average is sitting at $35.2 billion. Meaning that the revenue has indeed been growing. If we have a look at the graph, you can see that the trend line is indeed heading upwards, with the 5-year revenue CAGR sitting at 13.5% and the 10-year sitting at 5%, meaning that indeed in the past few years, the revenue of the company, the revenue growth of the company has been accelerating. And we can also see this by looking at the revenue growth graph. Through the past 5 years, you can see there is much more growth than through the 5 years before that. So based on this, I will rate pillar 1 as a B. And the reason why I'm not rating it as an A is because for an A, I would like to see a slightly higher revenue CAGR of maybe 18 to 20%. Now moving to pillar 2, we'll have a look at the net income CAGR. As you can see, through the past 10 years, the net income has been growing at a CAGR of 7.5%, with the 5-year net income CAGR growing at 18.19%, which is actually very nice. Now, to better see the growth of value, we can jump to pillar 5 and scroll down to the earnings per share growth. And as you can see, through the past 5 years, the EPS CAGR is sitting very close to the net income CAGR at about 19%. But moving back to pillar 2, we will rate the net income growth as an A, because through the past 5 years, a growth of 18% is something I consider very, very decent. Now, moving to pillar 3, the most important pillar from the financial growth, the free cash flow growth. And as we can see, the free cash flow has actually been growing phenomenally. You can see the trend line moving upwards, with the 5-year free cash flow CAGR sitting at 20.5% and the 10-year free cash flow CAGR sitting at 9.5%, meaning that I will rate pillar 3 as an A as well. Now, moving to pillar 4, we want to have a look at the profitability of Qualcomm. If we scroll down, you can see that through the past 10 years, the profit margin, the average profit margin has been sitting at 17%, with the 5-year average sitting at 25% and the current profit margin sitting at 26%, meaning that there is no doubt that the profit margin of the company has been increasing. And we can indeed see that the 5-year profit margin CAGR is sitting at 4%, higher than the 10-year profit margin, meaning that the growth of the profit margin has actually been increasing as well. And if we scroll down, we can see the return on invested capital as well. In 2024 and 2023, it has actually fallen slightly, but nevertheless, through the past 5 years, the ROIC is much higher than the 10-year average ROIC, meaning that overall, the ROIC has been growing, and it is actually currently sitting at a very decent value of 21. And as the current profit margin is also sitting at a very decent value, we will rate pillar 4 as an A. Now moving to pillar 5 and pillar 6, actually, we will look at the valuation of Qualcomm, specifically by looking at the PE and price to free cash flow ratios of the company. First, looking at the PE ratio, and this is something I love about Qualcomm, they are extremely cheap compared to their earnings, and they have been through the past 10 years, but they are even cheaper now. As you can see, through the past 5 years, they have been trading at about an 18 multiple, and currently they are trading at a PE of 15.6, which is cheaper than the 5-year average and very close to the 10-year average. Now, the reason why the 10-year average is so low compared to Qualcomm's peers is because Qualcomm hasn't really shown that much of growth, that much of revenue, net income, or free cash flow growth in the past 10 years. And that's why investors aren't willing to pay as much. But I believe that that is about to change, and Qualcomm will start growing their net income and free cash flow at least slightly faster than they have been throughout the past 5 or 10 years. So that is why I will have to rate pillar 5 as an A, as in my opinion, Qualcomm is trading really cheaply. And this is actually going to be the same case with pillar 6, the free cash flow, price to free cash flow. You can see that currently the price to free cash flow is sitting at 15.5 as well. And that is actually cheaper than through the past 5 or through the past 10 years. So indeed, we will have to rate pillar 6 as an A as well. Now, moving to pillar 7, we will have a look at the dividend growth of Qualcomm and the dividend safety of Qualcomm. So currently the company has a dividend yield of about 2%, with their dividends growing very steadily through the past 10 years at a CAGR of 6%, with the 5-year CAGR actually slipping slightly from the 10 years, sitting at only 5.5%. Now, what is also important to look at is the free cash flow payout ratio. Now, as we can see, the free cash flow payout ratio has actually decreased from the 10-year and from the 5-year average, currently sitting at 33.50% as of 2024, meaning that Qualcomm still has enough free cash flow to push into increasing their dividend, or for example paying down debt or buying back shares, which is something I love and specifically find very important for companies that have to push a lot of money into innovation to have a low free cash flow payout ratio. Now, as the dividend CAGR is sitting quite low to my liking, I like the dividend CAGR to be sitting maybe at 10% with maybe a slightly lower dividend yield, as I am a long-term investor. I will give pillar 7 a B grade and not an A grade. Moving to pillar 8, we will do a debt analysis on Qualcomm, specifically by looking at their long-term liabilities. We can see that through the past 5 years, the company has lowered their long-term liabilities, even though that through the past 10 years they have actually topped them slightly. But the main thing we want to have a look at is the long-term liabilities over the 5-year free cash flow negative dividends ratio, which tells us if the company generates enough free cash flow to cover all their long-term liabilities within an acceptable amount of time, while of course paying out their dividend. And a ratio of 0.45 tells us that Qualcomm would be able to pay off all their long-term liabilities in about 2 years if they were to use their 5-year average free cash flow. So again, I will rate pillar 8 as an A. And now moving to the final pillar, pillar 9, we will have a look at the 10-year decreasing shares outstanding. Through the past 10 years, Qualcomm has actually lowered their shares outstanding by about 500 million, which is quite a lot. The 10-year shares outstanding CAGR is sitting at negative 3.65%, with the 5-year sitting quite lower at only negative 0.34%, which leaves me slightly concerned, as I would expect Qualcomm to buy back more shares, specifically if they consider themselves undervalued and would like to raise the value for investors. Looking at these two CAGRs, I will give Qualcomm a B rating and not an A rating regarding their decreasing shares outstanding. Now, before moving to the intrinsic valuation, let's quickly sum up the 9-pillar analysis. You can see that for the financial growth overall, we would get an A grade. profitability shows an A grade as well, with the pricing of the company showing an A grade as well, dividend safety a B, debt management an A, and share buybacks a B, with the overall grade sitting at an A, which would be considered a strong buy. But to figure out the real rating of this company, we first have to go through the intrinsic valuation. So moving to the earnings per share valuation on Money Sense, I will plug in the max earnings per share CAGR at 20%. For the medium, I will go with 18%. And low, I will go with 17%. And this will give us an average CAGR into the future of 18.33%, which is actually slightly lower than the 5-year average. And when I scroll down, you can see that the intrinsic value comes out at $246, which is about 50% higher than the current trading price. So even with a safety margin of say 20%, we would still get a buy rating with a 19.52% difference. Now, for the sake of the valuation, I will remove the safety margin as I will apply one at the end of the video, and we will move forward with the A grade. Now, moving forward, we will jump to the Peter Lynch model, where we will use the same earnings growth estimate of 18.33% with the 5-year trailing PE ratio of almost 18, and we will get an intrinsic value of $198, which is 20% higher than the current trading price. Now, moving to the discounted cash flow model, into the future, into the next 10 years plus, into the long-term future, I will plug in the maximum free cash flow CAGR at 20%. For the medium, I will go with 17%, and low, I will go with 12%. Now, the WACC of the company is actually sitting quite high at 10.5%, meaning that investors do expect quite high returns as they buy the company quite cheap. So I will plug in my maximum discount rate at 11%. I will actually go at 11% all the way through. So we will have a 11% discount rate and a predicted free cash flow CAGR of 16.33%. And if I scroll down, you can see that without a margin of safety, we will get an A grade with the intrinsic value sitting at $238 compared to the current trading price of $166, 43% higher. So far, Qualcomm is looking very, very good. Now, moving to the multiples valuation, I want to compare Qualcomm to two companies, NVIDIA and MU. So I will plug in the ticker of these two companies. And when I scroll down, you can see that indeed Qualcomm is very cheap compared to the average P ratio of these two companies combined, sitting at 38, as well as the average price to free cash flow sitting at 43. Now you can see that NVIDIA is really bringing the average up, with the P ratio sitting at 51 and price to free cash flow sitting even higher at 61. So what I will actually do is remove NVIDIA from this valuation, and we will compare Qualcomm to strictly only MU. And this will give us a B grade with an intrinsic value of $217.23, 17% higher than the current trading price. Now for the dividend discount model, I will plug in the maximum dividend CAGR into the future at 10%, as we saw, Qualcomm has quite a low free cash flow payout ratio, so I believe that they can afford to raise their dividends at a higher rate. The medium dividend CAGR I will plug in at 9%, and the low dividend CAGR I will go with 7%. And this will give us a projected dividend CAGR of 8.67% into the future. The discount rate I will plug in at 11%, and this will give us an intrinsic value of $156, which is actually 6.35% lower than the current trading price of $166. So now when we jump to the ultimate valuation, we have all these models selected, all the models that we went through are selected. We will plug in a margin of safety of 10%, which is the lowest margin of safety I would personally go with. And as you can see, we'll average out the Graham's formula, the Peter Lynch model, discounted cash flow model, multiples valuation model, and the dividend discount model, and get an ultimate intrinsic value of $211.68, which is 14.39% higher than the current trading price if we account for the safety margin, which means that we get an acceptable buy price at $190.51, which is higher than the current trading price. So now when we jump to our final rating and move to the intrinsic value, you can see that indeed we got an A grade for the Graham's formula, multiples valuation is B, discounted cash flow model is A, Peter Lynch is B, and dividend discount model is C. And that's why the overall rating is a B, which is a buy rating. And therefore, as we got a strong buy rating for the 9 pillars and a buy rating for the intrinsic value models, we will get an overall buy recommendation for Qualcomm at the current trading price. I hope that you enjoyed the video, and make sure to check out moneysense.com to do some simple but effective analysis. If you use the code down below, FutureRich, you will get 20% off for your first month as well as a 7-day free trial.